Welcome back, future CPAs. This is part 3 of our series, Financial Reporting, which covers the first area of the Financial Accounting and Reporting section of the AICPA exam. If you're new here, don't forget to hit subscribe and share this with your fellow CPA candidates who are looking for quality review materials for free. This program is built to help you learn more efficiently and less time. We start with multiple choice questions as the foundation, then zoom out to connect them with key topics and align everything with the AICPA exam's representative tasks. The multiple choice questions used in the discussion are carefully designed to integrate multiple key concepts in one question. The visuals are kept minimal on purpose, so you can also treat this like an audiobook. Perfect for maximizing your study time on the go. Wishing you the best on your CPA journey. All right, here is the next problem. Scenario 1231 20x5, non-governmental, not-for-profit entity. From the trial balance and support for Community Arts Fund. Cash and cash equivalents, unrestricted $400,000, includes $200,000 conditional grant proceeds. Donor restricted $150,000. Pledges receivable, unconditional, due next year, $300,000, no allowance or discount needed. Investments, permanent endowment at fair value, $480,000. Original gift, $500,000. Underwater by $20,000. What is a permanent endowment? A permanent endowment is a donor-restricted gift where the principal must be maintained in perpetuity. In this case, a donor gives $500,000 and says, you can never spend the original gift, only use the earnings to support your mission. In accounting terms, that's always classified as net assets with donor restrictions because the donor imposed that restriction. What does underwater mean? Normally, this is the fair value of the endowment investments, what they're worth in the market today, is equal to or greater than the original gift amount. Original gift, principal, here, equals $500,000. At 1231, the fair value of the investments is $480,000. That means the investments are worth less than the gift by $20,000. This shortfall is called an underwater endowment. It can happen if the market drops or the endowment suffered losses. Property and equipment, net, $900,000. Accounts payable, $120,000. Note payable, $300,000. Conditional grant, barrier plus right of return not met at 1231, recorded as contribution revenue by the bookkeeper, needs correction. Assume no other releases of restrictions and no additional prepaid/allowances beyond the facts above. First, I'm putting on my not-for-profit hat, ASC 958 time. Two big moves here. Fix the conditional grant and classify net assets correctly, including that underwater endowment and the time-restricted receivable. Now, let's clean up the conditional grant. They got cash, but the barrier and right of return aren't met at 1231. In not-for-profits, contributions fall into two buckets. Unconditional contributions, revenue immediately. Conditional contributions, not revenue yet, instead recorded as a liability until the condition is met. The condition is defined by two things. One, a barrier, something the organization must overcome, like achieving a milestone, incurring qualifying expenses, or meeting a specific performance goal. And a right of return, or release, the donor can demand the money back or can stop future payments if the barrier isn't met. If both exist, the contribution is conditional. In our scenario, the organization, Community Arts Fund, received $200,000 cash before year-end. However, as of 1231, the donor's conditions were still outstanding. The not-for-profit hadn't yet overcome the barrier. For example, maybe they needed to match funds or run a certain program, and the donor still had a right of return, meaning if you don't do it, give the money back. So at 1231, the not-for-profit is essentially just holding someone else's money. It hasn't earned the contribution in GAAP terms. So that $200,000 sitting inside unrestricted cash doesn't change cash. We keep the cash, but it must be a liability. Call it refundable advance, not net assets. Therefore, we reverse the revenue the bookkeeper recorded and book a liability for $200,000. Yes, it's still cash in the bank, but it's not your money yet. Mom gave you lunch money, but only if you actually go to school. We determine totals, assets, and liabilities after the fix. Assets, just add them up. Cash, unrestricted 400K, plus donor restricted 150K, equals $550,000. Pledges receivable, unconditional, due next year, $300,000. Endowment investments at fair value, $480,000. Property and equipment net, $900,000. Total assets equals 550 plus 300 plus 480 plus 900 equals $2,230,000. Liabilities: accounts payable, $120,000. Note payable, $300,000. Refundable advance conditional grant, $200,000. Total liabilities equals $620,000. So total net assets equals $2,230,000 minus $620,000 equals $1,610,000. Next, we split between with and without donor restrictions. Now we channel ASC 958205, the presentation. With donor restrictions, what belongs here? Donor restricted cash, $150,000. Unconditional pledges due next year, $300,000. That's a time restriction, so it stays in with donor restrictions until next year when collected or released. Permanent endowment, underwater, fair value $480,000. Under today's guidance, underwater endowments remain in net assets with donor restrictions. You do not shove the deficiency to without. You keep the endowment in with donor restrictions and disclose the original gift, fair value, and the deficiency. So we include $480,000 here. Add them up. $150,000 plus $300,000 plus $480,000 equals $930,000 in with donor restrictions. Without donor restrictions is just the plug to total net assets. $1,610,000 total net assets minus $930,000 with donor restrictions equals $680,000 without donor restrictions. So the correct answer is option A. Without donor restrictions, $680,000. With donor restrictions, $930,000. That's our pair. So, in summary, in a conditional contributions, if barrier plus right of return aren't met, no revenue. Record refundable advance, a liability. If the unconditional pledges is due next year, time restricted, that is, with donor restrictions until collected or available for current use. For underwater endowments, classify the entire endowment within net assets with donor restrictions, even if fair value below original gift. Disclose the original gift, fair value, and deficiency. Spending is a policy matter, but classification stays with donor restrictions. For property and equipment, absent donor restrictions on the long-lived assets, they sit in without donor restrictions. The placed-in-service approach dominates practice. Move conditional cash to a refundable advance. Keep time-restricted pledges and underwater endowment with donor restrictions. Plug the rest to without. Here, that lands at $680K without and $930K with. All right, here is the next problem. You're preparing the statement of activities for Neighborhood Tutoring, Inc., a non-governmental, not-for-profit entity, for the year ending 12/31/20X5 using the following: revenues and support, program service fees, $600,000, contributions without donor restrictions, $150,000. Contributions with donor restrictions recorded for $100,000, but cash is conditional, barrier plus right of return not met. This was incorrectly recognized as WDR revenue. Releases from donor restrictions, purpose satisfied, STEM lab spending, 250,000, time satisfied, pledges collected, 50,000, total releases, 300,000, expenses. Okay, program, 520,000, management and general, 110,000, fundraising, 90,000, total expenses, 720,000. Error, $40,000 of fundraising was booked to program. Question. After correcting the conditional gift and the functional reclass, what are the change in net assets without donor restrictions and the change in net assets with donor restrictions for 20x5? Also, where may the required analysis of expenses be presented? Okay, big picture. This is straight out of ASC 958, not-for-profits, and ASU 2016-14. We're going to do three things. 1, fix the conditional gift. 2, process the releases. And 3, correct the functional expense reclass. Don't panic. We'll keep total straight and the coffee hot. First, the conditional $100,000. Because there's a barrier and a right of return not met by 1231, that money is not revenue yet. It belongs as a refundable advance, a liability, until the condition is met. For statement of activities purposes, we remove that $100,000 from revenue. And yes, if the bookkeeper shoved it into the wrong bucket, we still take it out of revenue altogether. It doesn't belong in either net asset class yet. Now, let's compute the change in net assets without donor restrictions. Start with what increases WDR without donor restrictions. Program service fees, $600,000. Contributions without donor restrictions, $150,000. Releases from restriction, purpose $250K plus time $50K, $300,000 flow into WDR. So subtotal inflows to WDR, 600 plus 150 plus 300 equals 1,050,000. Then subtract total expenses. After we fix the function labels, the total is still $720,000. Reclass doesn't change the sum. So provisional change in WDR equals 1,050,000 minus 720,000 equals 330,000. Does the conditional $100,000 reduce WDR? In GAAP land, that conditional amount isn't revenue anywhere. We kick it out entirely and park a liability. Because the $100,000 was not a valid WDR inflow, our $1,050,000 already excludes it. So our WDR change stays $330,000. If the books had mistakenly pumped the $100,000 into the WDR line you're adding up, you'd remove it here. Same destination. Next, the change in net assets with restrictions. What increases WDR with restrictions? Valid restricted contributions of $400,000. What decreases it? The releases we already noted, $300,000 out. The conditional $100,000 never qualified as revenue, so it stays out entirely. Net change with donor restrictions equals $400,000 minus $300,000 equals $100,000. The functional reclass, moving $40,000 from program to fundraising, changes the by-function split. Program becomes $480K, fundraising $130K, and management and general $110K, but the total remains $720K, so it doesn't change the net asset totals. It does clean up your statements and keeps the auditors from developing a facial tic. Finally, presentation of the analysis of expenses by nature and function under ASU 2016-14, you can present it on the face of the statement of activities, in a separate statement of functional expenses, or in the notes. GAAP gives you menu options. Order what pairs best with your formatting. So our answers line up as $330,000 without donor restrictions, $100,000 with donor restrictions, and the expense analysis may be on the statement of activities, in a separate statement, or in the notes. That's choice A. Remember, conditional equals liability. Releases flow to with donor restrictions. Fix function labels, but totals don't change. Expense analysis can live on the face, in its own statement, or in the notes. And breathe. You've got this. All right. What if the donor confirms in January 20x6 that the barrier has been met? Since the condition was satisfied after year-end but before issuance, this becomes a non-recognized subsequent event under ASC 855. You don't retroactively recognize it as 20x5 revenue. You simply disclose in the notes that the grant became unconditional. The trap is to accidentally add $100,000 back into 20x5 revenue. Don't. Recognition happens in the period the condition is actually met. Now, suppose the donor restricts $200,000 of contributions for equipment acquisition next year. Under ASC 958-205, that's a time restriction. So the contribution increases net assets with donor restrictions until the equipment is purchased and placed in service. When the asset is placed in service, the restriction is released to without restrictions immediately. No depreciation-based release needed under the placed in service approach. The exam loves this twist to check if you still remember that long-lived asset restrictions don't dribble out over time. They release all at once when the asset is put to use. All right, here is the next question. You're preparing the statement of cash flows, indirect method, for Helping Hands, Inc., a not-for-profit entity, using the items below. Change in net assets, plus $420,000, depreciation, $90,000, unrealized investment gain, $10,000, loss on sale of equipment, $5,000, donated equipment recognized, $30,000, AR increase, $30,000, AP decrease, $15,000, prepaids increase, $20,000, deferred revenue increase, $12,000, cash contribution with donor restrictions for a long-lived asset received, $200,000, equipment purchase, $250,000, proceeds from sale, $40,000, note payable repayment, $60,000. Question: using the indirect method and correcting misclassifications, what are 1. Net cash provided by operating activities, and 2. Total net change in cash for 20x5? Okay, deep breath. This is a textbook indirect method NFP question under ASC 230 and ASC 958. I'll walk you through how to rebuild the operating section, fix the non-cash and restricted items, and make sure we land on the right change in cash. Let's start with the change in net assets. That's your equivalent of net income in for-profits. Then, add back non-cash and non-operating items. We're doing the indirect method, so we reverse the non-cash stuff embedded in that 420K. Depreciation expense, $90,000, non-cash add back. Unrealized investment gain, $10,000, non-cash gain, remove it. Loss on sale of equipment, $5,000, non-cash loss, add back. Donated equipment, $30,000, non-cash contribution, reverse, because it inflated income but didn't affect cash. Next, we adjust for changes in working capital. Remember your mnemonic. Current assets opposite, current liabilities same. AR increased $30K, minus $30,000 cash out. Prepaids increased $20K, minus $20,000 cash out. AP decreased $15K, minus $15,000 cash out. Deferred revenue increased $12K, plus $12,000 cash in. Finally, we adjust for restricted contributions. Here's the nonprofit twist. Cash received with donor restrictions for long-lived assets, $200,000, belongs in financing activities, not operating. Because the donor told you, use this for a building, you can't treat it as operating inflow. Under ASC 230-10-45-14 and ASC 958-230, restricted gifts for long-lived assets go under financing until the restriction is met. So we subtract $200,000 from operating. That's net cash provided by operating activities is $222,000. Now that we've got operating, let's complete the other sections for the net change in cash. Investing activities, equipment purchase minus $250,000, proceeds from sale plus $40,000, net investing equals minus $210,000. Remember, donated equipment is a non-cash activity. Just disclose it. Financing activities, restricted contribution for long-lived asset plus $200,000, note payable repayment minus $60,000. Net financing equals plus $140,000. Now add them all up. Operating plus $222,000, investing minus $210,000, financing plus $140,000. Net change in cash equals plus $152,000. That's A. Net cash from operating activities, $222,000. Net change in cash, $152,000. The statement of cash flows for a non-governmental, not-for-profit entity, NFP, serves the same overarching purpose as it does for for-profit entities, to explain how cash and cash equivalents change during the reporting period. But under ASC 230 and ASC 958-230, its objectives are tailored to the unique nature of NFPs. The goal is to help donors, creditors, and other users assess the organization's liquidity, financial flexibility, and ability to meet obligations, as well as its dependence on contributions and restricted funding. The NFP statement of cash flows must classify cash flows into operating, investing, and financing activities, just like a business entity, but with some special rules. For example, contributions restricted for long-lived assets are reported as financing inflows, not operating, and the purchase of those long-lived assets is reported as an investing outflow. This structure allows users to distinguish between day-to-day operating cash, investing in mission-supporting assets, and financing through contributions or borrowings. Non-cash activities, such as donated equipment or in-kind contributions, are disclosed separately because they affect net assets without affecting cash. Ultimately, the statement links the change in cash to the change in net assets, showing whether the organization's mission activities are generating or using cash. For CPA exam purposes, remember, NFPs use either the direct or indirect method, start with change in net assets if indirect, and always reconcile to the net increase or decrease in cash and cash equivalents. All right, next question. A city reports the following activities in the current year. Which fund classification should be used? Okay, let's break this down together. This question is a classic GASB fund classification exercise. It's not about numbers, it's about understanding why each activity belongs where it does. Think of it as learning which drawer each transaction goes into in the city's accounting cabinet. 1. Property taxes collected to finance general government operations. When the city collects general property taxes, no special earmarking, no specific project, it's the government's main operating fund. That means general fund. The general fund accounts for ordinary operations financed by general revenue sources, like property taxes. Every government has one, and only one, general fund. 2. Construction of a new library financed with bond proceeds. Now we're talking capital outlay financed by long-term debt. Construction of major facilities, libraries, city halls, fire stations, belongs in the Capital Projects Fund. Capital Projects Funds handle the acquisition or construction of major capital assets, especially when financed by bond proceeds or grants restricted for capital use. 3. Payment of principal and interest on those bonds. This one trips people up. Remember, once the bonds are issued, the debt service, repaying principal and interest, is not recorded in the Capital Projects Fund. It's handled in the Debt Service Fund. Debt service funds account for the accumulation of resources on the payment of general long-term debt, not enterprise debt, but general obligation debt. 4. City-owned water utility. All right, here's the business type activity. The water utility charges user fees and is intended to be self-sustaining. That's a dead giveaway for an enterprise fund. Enterprise funds are proprietary funds used when the government operates activities similar to private businesses, charging external users and expected to cover costs with those fees. Tip: if it serves the public and charges them, it's enterprise. If it serves other government departments, it's internal service. 5. Taxes collected for the county school district. Now, this one's purely custodial. The city is just holding and remitting cash. No real revenue, no expense, no accountability beyond passing it along. That's a custodial fund. Used to be called agency fund before GASP 84. Key concept: custodial funds are fiduciary funds used when the government collects and remits resources for others and has no administrative involvement or financial accountability for how they're used. Putting it all together, let's map them. 1. Property taxes for operations. General fund, main operating fund. Construction of library, capital projects fund, major capital outlay. 3. Payment of bond principal and interest, debt service fund, long-term debt payments. 4. Water utility, enterprise fund, business type self-supporting. 5. Taxes for school district, custodial fund, purely fiduciary, pass-through. That combination matches choice B. Again, general fund equals default drawer for general operations. Capital projects fund equals big builds and bond-financed assets. Debt service fund equals long-term debt repayment. Enterprise fund equals business-type activities serving the public. Custodial fund equals someone else's money just passing through. Here are a couple variations on this question. 1. What if the water utility served only other city departments? Say it provides water just for city buildings. Then it would be internal service, not enterprise. 2. What if the taxes were restricted for a specific public program, like street maintenance? Those could go into a special revenue fund, not the general fund. So when you see property taxes, think general fund. Bond-financed construction, capital projects. Paying those bonds, debt service. Fee-based utilities, enterprise. Pure pass-through collections, custodial. Once you master that map, you've got the backbone of governmental fund accounting nailed down. State and local governments use two distinct measurement focuses and bases of accounting depending on whether they are reporting at the fund level or government-wide level, as prescribed by GASB. Governmental funds, like the general, special revenue, capital projects, debt service, and permanent funds, use the current financial resources measurement focus and the modified accrual basis of accounting. This means they recognize revenues when they are both measurable and available to finance current period expenditures, and expenditures when liabilities are incurred and expected to be paid from current financial resources. In contrast, proprietary funds, enterprise and internal service, and fiduciary funds, custodial and trust funds, as well as government-wide statements, use the economic resources measurement focus and accrual basis of accounting. Under this approach, all assets and liabilities, both current and long-term, are reported, and revenues and expenses are recognized when earned or incurred, regardless of when cash is received or paid. This dual approach allows governments to show short-term fiscal accountability at the fund level and long-term operational accountability in the government-wide statements. On the CPA exam, always remember, modified accrual equals current focus, full accrual equals economic focus. All right, next question. Which statement correctly describes the primary purpose of each SEC filing for a U.S. registrant? Okay, let's unpack this together. This question tests your understanding of the SEC's periodic reporting framework under the Securities Exchange Act of 1934. And it's one of those topics that keeps appearing in the FAR Core and the Business Analysis and Reporting (BAR) discipline of the 2025 CPA exam. The SEC's whole idea is simple. Keep investors informed year-round. So every public company must file 3 recurring reports, the 10K, 10Q, and 8K, each with a different timing and purpose. Let's go through the forms first, then we'll get back to the answer choices. Form 10K, the annual story. Think of the 10K as the company's annual autobiography. It includes audited financial statements, full footnotes, MDA, management's discussion and analysis, and detailed disclosures on risks, governance, and internal control. The 10K basically says, here's the official audited truth about our year. It's due within 60 to 90 days after year end, depending on filer size. Key phrase to memorize. 10K equals audited, annual, comprehensive. Form 10Q, the quarterly check-in. Now, the 10Q is your quick mid-year update. It's filed for each of the first 3 fiscal quarters, no fourth quarter 10Q, because the 10K wraps up the year. It includes unaudited, condensed financial statements, interim MDA, and updates on any major changes since the last annual filing. In short, the 10Q says, here's what's new this quarter. No audit stamp yet, but still GAAP compliant. Key concept, 10Q equals interim plus unaudited plus quarterly transparency. Form 8K, the breaking news alert. Now, the 8K is like a press release with legal weight. It's filed whenever a material event occurs that investors need to know about before the next 10Q or 10K. Examples? Mergers, bankruptcies, auditor changes, resignations of key officers, or major acquisitions. It must be filed within 4 business days of the event. So, 8K equals something big just happened. Now, let's analyze the options. Option A, wrong. It completely flips 10K and 10Q. The 10K is annual and audited, not the 10Q. Plus, proxy materials go on Form DEF 14A, not 8K. Option B, nope. The 10K isn't a registration statement, that's Form S1, and insider trading disclosures use Forms 3, 4, and 5, not the 10Q. Option C, still wrong. The 10Q definitely includes financial info, and 8Ks are mandatory for specified events, not optional. Option D, perfect. Annual audited 10K, quarterly unaudited 10Q, and current event 8K. Correct answer, D. Exam tips. 10K equals annual and audited, 10Q equals quarterly and unaudited, 8K equals material event and mandatory. If you see registration or proxy, that's a trick. Those belong to Forms S1 and DEF 14A. Remember, the CPA exam now tests this under FAR and BAR, especially when evaluating disclosure and reporting requirements for SEC registrants. So next time you see Form 10 whatever, just smile and remember this simple rule. K equals year, Q equals quarter, 8 equals breaking news. That's the SEC filing system in a nutshell. Short, sharp, and investor-friendly. Okay, next question. Which pairing correctly matches the item captions required by the SEC for Form 10Q, Part 1 through 3, and Form 10K, Part 2, Items 7, 7A, and 8? Okay, this question tests your knowledge of the structure and content of SEC filings under Regulation SK, and it's squarely within the financial reporting and disclosure area of the 2025 AICPA exam blueprint, tested in both FAR Core and BAR discipline. Now, remember, these filings aren't random lists. The SEC organizes each form into parts and items, and each item has a defined caption. Your job is to recognize the official sequence because the CPA exam loves to test whether you can spot when the order or the wording is slightly off. Let's go step by step and decode this. First, Form 10Q, Part 1, Items 1 through 3. Form 10Q is the quarterly report, so Part 1 focuses on financial information and updates. The SEC wants 3 main sections, right up front. Item 1, financial statements. This includes the condensed, usually unaudited, quarterly financial statements. Item 2, management's discussion and analysis, MDA. Management explains the financial condition and results of operations, just like in the annual report, but focused on interim trends. Item 3, quantitative and qualitative disclosures about market risk. This is about exposure to things like interest rate risk, foreign currency risk, or commodity price risk, but it's only required for larger registrants. Smaller reporting companies can omit it. So the correct 10Q order is financial statements, MDA, market risk. Next, Form 10K, Part 2, Items 7, 7A, and 8. Form 10K is the annual report, and Part 2 gives a deeper dive. Item 7, MDA, Management's Discussion and Analysis, a full audited year version of the same MDA idea, but broader in scope and more detailed. Item 7A, quantitative and qualitative disclosures about market risk. Again, this is where companies describe their market exposures, interest rates, foreign currencies, derivatives, etc. Item 8, financial statements and supplementary data. The audited financial statements go here: balance sheet, income statement, cash flows, and all notes. So for 10K Part 2, MDA, market risk, financial statements. Now, going back to the answer choices, the perfect match is choice C. 10Q, 1, financial statements, 2, MD&A, 3, market risk. 10K, 7, MD&A, 7A, market risk. That's exactly what Regulation SK requires. Let's simplify this with an easy memory aid. Quarterly reports, 10Q, FMM. Financials, MDA, market risk. Annual reports, 10K, MMF. MD&A, market risk, financials. You can even think of it like reading a story. 10Q tells you what happened this quarter. 10K retells the story for the whole year, with a full audit and extra disclosures. If you see audited or supplementary data, think 10K Item 8. If you see interim or unaudited, think 10Q Item 1. If you see market risk, it's always Item 3 on the 10Q or Item 7A on the 10K. And one final trick: if the answer choice puts MDA before financials in the 10Q, it's wrong. If it puts financials last in the 10K, it's right. So, bottom line, 10Q Part 1 is financials, MDA, market risk. 10K Part 2 is MDA, market risk, financials. Once you memorize that pattern, you'll crush every SEC structure question they throw at you. Again, final answer, choice C. Okay, next question. Riverton Tools, Inc. reports the following for the year ended December 31, 20X5. All instruments outstanding all year, tax rate 25%. Earnings and shares. Net income, GAAP, 1,200,000. Weighted average common shares outstanding, WAXO, 500,000. Preferred stock, cumulative. Non-convertible preferred, 10,000 shares at $100 par, 6% dividend, $60,000. Convertible preferred, 5,000 shares at $100 par, 8% dividend. Each share converts into 3 common shares, $40,000. Stock options, treasury stock method. 100,000 options, exercise price 20, average market price 25. Convertible debt, if converted method. $2 million of 5% bonds, convertible into 80,000 common shares. Required, compute basic EPS and diluted EPS for 20x5. All right, candidate, deep breath. This is a classic earnings per share question under ASC 260. It looks intimidating, but we'll go step by step. Our goal? Compute basic EPS first, then diluted EPS. We'll apply the if converted and treasury stock methods correctly, just like the exam expects. Let's do this systematically. Step 1, compute basic EPS. The formula for basic EPS is basic EPS equals net income minus preferred dividends divided by WACSO. We have 2 preferred types. Non-convertible preferred, we always subtract its dividends. Convertible preferred, we subtract dividends for basic EPS only because we haven't converted them yet. So, net income equals $1,200,000 less preferred dividends equals $60,000 plus $40,000 equals $100,000. Therefore, income available to common equals $1,200,000 minus $100,000 equals $1,100,000. Now divide by common shares. Basic EPS equals 1,100,000 divided by 500,000 equals $2.20. Basic EPS equals $2.20. So far, easy. Now comes the fun part, diluted EPS. Step 2, compute diluted EPS. Diluted EPS equals net income plus after-tax adjustments from assumed conversions divided by WACSO plus shares from assumed conversions. We'll test each potential dilutive security one by one. Convertible preferred stock, convertible bonds, stock options. We only include those that decrease EPS. That's what dilutive means. 1. Convertible preferred stock, if converted method. Dividends equals $40,000. Shares if converted equals 5,000 times 3 equals 15,000 new shares. If converted, we'd add back the $40,000 dividends since they'd no longer be paid and add 15,000 shares. 2. Convertible bonds, if converted method. Interest equals 5% times $2 million equals $100,000 interest expense. After tax equals $100,000 times 1 minus 0.25 equals $75,000. Add back $75,000 to net income. Add 80,000 shares. 3. Stock options, treasury stock method. We use the treasury stock method because these are options. Here's how it works. 100,000 options exercised at $20 means company receives $2 million. At $25 market price, company could buy back 80,000 shares. That is, 2 million divided by 25. So net new shares equals 100,000 minus 80,000 equals 20,000 incremental shares. Now, we add that 20,000 shares to the denominator when computing diluted EPS. Step 3, Put it all together. Diluted EPS equals 1,215,000 divided by 615,000 equals $1.9756, roughly $1.96. Correct answer, B. Basic, $2.20, diluted, $1.96. Let's simplify the key concepts here. 1. Basic EPS equals reality, current shares after subtracting all preferred dividends. 2. Diluted EPS equals imagination. Assume everything that could convert into shares actually does. 3. If converted method used for convertible bonds and preferred stock. 4. Treasury stock method used for stock options and warrants. 5. Include only dilutive instruments. If conversion increases EPS, ignore it. Exam tips. Always start with basic EPS first. For convertibles, add back interest, net of tax, or dividends. For options, remember, only include in-the-money options when market greater than exercise price. Work neatly. EPS problems are about structure more than numbers. Basic EPS shows what happened. Diluted EPS shows what could happen if everyone cashed in. Once you get this logic down, you'll nail every EPS question. No calculator panic required. Again, final answer, B, basic $2.20, diluted $1.96.